Hello, everybody, and welcome to today's masterclass. For those of you who don't know me, my name is Jessica Blumenthal, and I'm an executive in the Banking and Finance Department of ENS Africa. And today I'm joined by two of my colleagues from the Banking and Finance Department, Arabella Bennett and Roger Rudolph, and we'll be talking about emerging risks for pension fund trustees. Just a reminder that this masterclass is one of a series of masterclasses which have been put together to allow our clients and members of the financial services sector to comply with their continuous professional development obligations. So we've been running this masterclass series through April, and now we'll be doing so for the rest of May to allow those of you who need CPD hours to attend them all before the cycle ends at the end of the month. Remember that if you are here for CPD hours, you can get a certificate after this masterclass. Our team will arrange one for you, but we do need to be able to verify that you've been in attendance for the duration of the class. So please do stay online. We do check the online stats, and so it will take a day or two to get your certificate to you, but that's what we're doing. We're verifying attendance. So please do remember that. The CPD series this year, similarly to last year, has been focused on issues that we think are of import for the financial services sector, with a particular focus on ESG. Last year, when we ran the CPD series, we in a sense sought to raise baseline understanding, and so our ESG sessions were perhaps more introductory. But even so, we used the series last year, and we're doing so again this year, to introduce you to some of our experts from different departments in the firm, and even from some of our different offices, pulled together into teams to talk about issues that we think are relevant and thought-provoking. So that's more background around the series. This year, we've tried to present masterclasses. And so this particular masterclass today, which perhaps fits most easily under the G of ESG, is directed particularly to the pension fund industry, to trustees and their service providers. And Arabella, Roger, and myself will be taking you through some of the hot topics or things to watch, and really just to start the conversation with you. We did give an opportunity for people to send in questions, and thank you to those who did. They've been taken into account and worked into the presentation. If there are any burning issues or questions that you have after listening to the masterclass today, please don't hesitate to reach out to Arabella, Roger, or myself with your questions, depending on whose topic you want to interrogate further, and we will engage with you directly on that. So without wasting any more of our time, because I think we've got quite a jam-packed session, I'm going to hand over to my colleague Arabella to kick us off. Thanks, Arabella.
Hi, good afternoon, everyone. Thank you for joining us. I am going to put up the presentation. So as Jess said, we are going to be talking about the key risks for trustees and their service providers today. As pension experts, we've selected topics that we think are particularly pertinent at the moment. I'm going to kick off the series by talking about the two-pot system, unclaimed assets and insurance risks. Jessica's cyber risks follows closely and is intertwined with my insurance risk section. And then Roger Rudolph will be speaking about bank resolution and Regulation 28 development. So as far as my section is concerned, I will spend a bit of time on the two-pot system, a fair bit of time, and then the unclaimed assets and insurance sections will be much shorter. So the so-called two-pot system, for those of you who haven't already attended reams and reams of webinars and conferences and whatever that have dealt with the two-pot, I just want to give you a little bit of context in terms of the timelines that have preceded the so-called two-pot system coming onto the retirement fund radar. So on the 29th of July, a draft revenue law amendment bill, otherwise known as RLAB, was published together with a draft explanatory memorandum. So this is not the Taxation Law Amendment Bill or TLAB, but the RLAB. It was accompanied by a media statement issued by National Treasury on the 31st of July, which spoke about National Treasury's intention behind this retirement reform. In August, National Treasury and SARS briefed the Select Committee on Finance. And thereafter, well, from the publication in July of the draft, industry was invited to submit comments. Industry players such as ourselves submitted extensive written comments by the due date on the 29th of August. And a workshop then ensued where those of us who'd submitted comments and various stakeholders met in September. There were oral presentations by taxpayers and tax advisors, including our ENS tax team in September. A draft response was prepared, and National Treasury and SARS then presented that draft response to the Select Committee. So where are we now? Because of the intensity, depth, and breadth of the industry comments and the concomitant amendments that are needed to be made to this piece of legislation, National Treasury and SARS didn't finalize the RLAB as part of this legislative cycle. Then following the budget review in February, the 2023 budget review document stated in Chapter 4, I've included there for those of you who are interested in the slides afterwards, but please don't bother to read it now, a lengthy statement that basically said, following extensive consultation, this piece of legislation will come and take effect on 1 March next year. The intention is the following. There are 4 areas that require intensive further investigation, and please expect draft legislation to come into effect this year. So what is potting with these pots? Okay, the so-called 2-pot system. So a bit of a spoiler alert, there are actually 3 pots. So there's the so-called vested pot, which is the world as we know it, prior to the enactment of this legislation, according to the regulators by 1 March 2024. And then after 1 March 2024, we'll have 2 other pots, the savings pot and the retirement pot. I'm going to unpack them a bit for you. So what is behind all of this? Okay, behind all of this is a world of complexity. It is the RLAB, as it currently describes the 2-pot system, is the regulator's attempt at pulling together a host of different things. On the one hand, responding to post-COVID retirement fund trends, particularly employees terminating employment in order to access their retirement savings due to economic hardship. Those of you who are in the retirement industry will know that employers were given respite during COVID to cease making retirement contributions for a certain period of time. This obviously also had an impact. The economic crisis, on the one hand, the regulator is saying we want to preserve retirement funds. On the other hand, they're saying we need to give people access to their retirement savings so that they don't resign from their jobs in order to access that. And all the while, this is set in the context of South Africa, where the percentage is minuscule of people who can actually sustainably retire on their retirement savings. So, in Afrikaans, one would say this is the yellow books in dice in the RLAB as it currently stands. So let me start with the pots, and I'm going to go through this really quickly because it's not final. As I've said, the comments were extensive. There are a lot of problems. They need to be fixed. The regulator is still saying 1 March next year. I don't know how that's possible. So let me gallop through it quickly so that you can get a sense of it. So before 1 March, you have the vested pot. You'll remember that's on the one side of my pictures with the 3 pots. So that's everything you've built up in your retirement fund up to 1 March 2024, if that ends up being the date. That stays in your vested pot. That's the world as we know it. Then come 1 March 2024, or whatever the regulator, whatever turns out to be the actual effective date, notional walls go up that create 2 additional pots, okay? So now you have your vested pot, the pre-March 2024, and you've got savings, which will be empty, and you'll start contributing towards it. You'll start building it up. And your retirement pot, which will be empty, and you'll start contributing to it, okay? There are various caveats to all of this. So this is just a very bird's eye view for you. For example, members of provident funds or provident preservation funds who are 50 years or older on 1 March 2021 can continue to contribute to the vested pot. And you will see as I go along that the various caveats end up making the current proposal extremely complex. So one of the issues to know with this vesting is that there's the so-called seeding debate, which is raging on this topic. So that is how much of what is in your vested pot will be given to you in cash when the legislation comes up. Okay, there's a lot of confusion around members who are 55 years or older and who are members of this Provident Preservation Fund as at 1 March 2021, when for some of you who are in the know will know that there was this compulsory annuitization that took effect on 1 March 2021 that exempted certain people older than 55 and members of those funds from the compulsory annuitization rules. And that is what we in the industry are calling the first categorization of vested rights, okay? And how that interacts with then this vested pot and the other pots is very complex, and it hasn't been solved yet. And there are various tax issues that flow from that our tax colleagues, I'm not one of them, are on top of and spoke to the regulator about in our written comments. So the second pot, I'm calling it 2.1 because there's 2.2, which is the retirement pot. National Treasury confusingly is calling that the access pot. Okay, so you also have this confusion of terminology, but the RLab speaks about it being the savings pot. Okay, so while you're still in employment and a member of a fund, let's just call all retirement funds a fund, you can withdraw from your savings pot, i.e. you can access it. The proposal currently is once a year, minimum of 2,000 Rand, and you're going to be taxed at the marginal tax rates. In other words, they want to give you access, but they want to discourage you from unnecessarily withdrawing amounts prior to your retirement. Then on your retirement, we're still on the savings pot, you can do one of 2 things with your savings pot. You can withdraw all your funds in cash, or you can transfer it to your retirement pot. And that's where they come in with the preservation. So they really want to incentivize you not to withdraw too much from your savings pot and to transfer it to your retirement pot. So whatever you put in and have left in your savings pot and then took out as cash is called your cash component. And whatever you transfer to your retirement pot will be converted to an annuity. I'll get to that. So then the retirement pot, which National Treasury confusingly also calls the preservation pot, okay? So what goes in here after 1 March, after this effective date, this notional effective date, is 2/3 of your retirement fund contributions, plus your investment return, plus anything that you transferred into this from your savings pot. What comes out, if you withdraw as a member of a retirement fund, you get nothing from this pot. So they're trying to disincentivize people from quitting their jobs to access this pot. On retirement, the member's whole interest in the retirement pot, they say goes to an annuity, i.e. the total value used, the total value, notional value in your retirement pot will be used to purchase an annuity for your retirement benefits. And there's no once-off withdrawal from the preservation fund. So that's a whole nother topic, which is why I'm skimming over it. So what is going in and out of these pots depends on the circumstances, okay? While you're still in employment you can withdraw from your savings pot. When you withdraw from a retirement fund, everything that's in your savings pot gets paid into cash, or you can have it transferred to another fund. Nothing from your retirement pot is paid to you. You've effectively forfeited. National Treasury is still thinking about what to do in circumstances around retrenchment, because obviously that is not your elective spendthriftiness. Everything in the vested pot is then paid or transferred. When you retire, in summary, what goes in and out. So everything that's in your savings pot is paid, is cashed out effectively, or transferred to your retirement pot, whatever you chose. And what's in your retirement pot gets annuitized. What's in your vested pot is paid 2/3 annuity and up to 1/3 cash, depending on the annuitization rules pertaining to the fund. So you'll remember my earlier statement about the exemption from the compulsory annuitization, the first vesting, as I called it, for people over 55 and members of a Provident and Provident Preservation Fund. So I'm sure you feel that now this is a ball of string that is quite convoluted and needs to be unraveled. And that is where we stand, okay? It is unclear, it is confusing. There are these rules, then there are the departures from the rules and the departures from the departures and so on. But the regulator has said very firmly, and most notably just 2-3 weeks ago at the Pension Lawyers Conference and the International Pension Lawyers Conference, that they are standing by their 1 March 2024 deadline. And this is in the context of us obviously not having seen the draft legislation, which is typically issued in July, which is subject to amendment by Parliament, and then typically gets promulgated in January the following year. So we're talking about January next year, we might see the draft legislation. Then every retirement fund needs to amend its rules to align with this. Then those amended rules need to be passed by the boards of trustees. Then they have to be approved by the Financial Sector Conduct Authority. And those of you who have tried to submit rule amendments lately have known that they can take some time. You will need to, all retirement funds and administrators will need to change their administration and asset investment systems to take into account the various pots. Investment holdings might need to be adjusted in order to create liquidity for the withdrawals from the savings pot. Retirement funds will and service providers will need to lock down their cyber and insurance risks associated with these new system changes. The actuaries will obviously need to get comfortable that they can still liability match, and that the retirement funds funding levels are still looking good, notwithstanding prospective withdrawals. There needs to be communication with members, and members will then need financial and tax advice in order to know what to do. So in summary, if 1 March 2024 is the deadline, I think this will be a really big ask for the industry. Okay, so those are the pots. So to move on to something slightly lighter, in terms of technical complexity, but of great import, is the regulator's stance on unclaimed assets. So many of you will know that this is a topic that is close to the heart of the regulator. It is a problematic area for the South African financial services industry and predominantly retirement funds because of the vast sums of unclaimed benefits, many of them dating back to poor apartheid-related practices where migrant labor, migrant laborers weren't properly documented. Employers didn't always have IDs, contact details, and so on. So we're sitting with billions in unclaimed assets. So what's now happened is that the FSCA has put out a discussion paper which in September last year, which is a framework not only for unclaimed assets in the retirement sector, but in the whole financial sector, okay, and has called for public comments on that. In that document, the FSCA makes 13 recommendations of what it thinks we should do with how we should deal with unclaimed benefits. They say that retirement funds are by far the leader in dealing with unclaimed assets, which is not good, in my opinion. The main recommendation is to set up an unclaimed assets fund. This won't be new to you. It's been on the cards for years. The regulator feels very strongly about the prioritization of tracing. And I have to just give you one quick anecdote here, and that is that COVID was the perfect time for many of our retirement funds to trace their unclaimed benefits, because everybody went home for the hard lockdown. And I don't know why this hasn't been reported more in the press, but the results were astounding of the billions that flowed back into the hands of members. The regulator has looked at the international scene and at the International Pension Lawyers Association conference. We also heard from Brazil and the UK and whatever, how they're dealing with unclaimed assets. So what has the regulator said about the causes of the high volumes of unclaimed benefits? They're saying employers aren't taking the necessary steps to track beneficiaries. They're saying there's too much information for employers to manage, that beneficiaries don't keep the administrators updated with personal information, and that a centralized database may be the most effective way to resolve the problem of lost pension accounts. They say that the centralized fund should be either an unclaimed assets fund or it should go into the National Revenue Fund, that non-cash assets should be liquidated into cash before being transferred into the proposed centralized fund. And the proposal is that the liability for transferred unclaimed assets will then sit with this notional centralized fund and no longer with the financial institution. So what is said about these funds in this proposal document? The central fund is supposed to be run by experienced industry board members, whatever that means. The National Revenue Fund is put up as a way of keeping costs low and not needing to establish a new structure, but their concerns around transparency. So what is the way forward through the eyes of the regulator? Is that financial institutions should be standardized and consistent in the manner in which they deal with unclaimed benefits. There must be threshold tracing costs. There must be proper consumer personal databases. And in general, the document speaks repeatedly about sort of monitoring tracing agents and tracing costs. In my view, they did a stupendous job over COVID. So then to move on to insurance. So, you know, particularly this two-pot system, in my view, just racks up fiduciary responsibilities for everyone in the retirement sector. And I wanted to mention insurance cover because this continues to be a very hot topic for our clients and for us on our transactions and in our advice to clients. So what I want to say is that when dealing with insurance cover for a retirement fund or for service providers of retirement funds, the quantum as well as the terms need to be right. And that we have this anomaly in insurance that warranties come from English law, and that a breach of a warranty in a policy of insurance results in the contract of insurance being void ab initio, in other words, from the get-go, and the insurer keeps all the premiums and doesn't pay out. So red flag for warranties. Reinsurance, offshore, onshore, reinsurance, offshore, onshore insurance. Many of you will know the saga of the Amplatz Fund and Vivian Cohen, but just to bear in mind that claiming from an insurer or a reinsurer or a P&I club offshore is not as easy as claiming on local soil. So that's me. I'd like to hand over to Jess, who is going to take you through cybersecurity and cyber resilience.
Thanks, Arabella. And I think actually this follows quite nicely from the points that Arabella has been making around insurance, because essentially I think the main takeaway from the cybersecurity and cyber resilience joint standard, which I'll talk about a little bit now, but perhaps the main takeaway is around understanding and managing the liability that is incurred by trustees when dealing not only with their risks within the fund itself, but also with contracting with service providers to the fund. So in the same way that Arabella is making the point around insurance and how critical really unpacking that is and understanding if there is adequate insurance cover, in the same way, from a fund's perspective or from a trustee's perspective, managing cybersecurity and cyber resilience actually becomes a contractual question of whether you have the correct protections in your service level agreements and your contracts with third parties. So many of you will know that this joint standard was first published for the first time in 2021, the end of the year. It tends to be a December joint standard. And there was extensive industry comment on the first draft, which then resulted in the second draft being published in December 2022. And from the responses to the comments, a lot of the comments that were made by industry were addressed by the regulators and taken into account in the second draft, but a lot of the concerns weren't addressed, or perhaps weren't addressed in such a way as to remove any of the risks that commentators foresaw for those financial institutions which would be subject to the joint standard. And so whilst we understand that the intention is to publish the joint standard in final form very soon, there is still some question as to whether if it's published in the second draft version, which industry has seen, whether how we will resolve those currently unresolved risks. The intention of the cybersecurity and cyber resilience joint standard is to set out minimum principles and minimum standards that need to be met by the financial institutions to which the standard applies, and those are listed. And in fact, the list of financial institutions to whom the standard applies expanded from the first draft to the second draft. For current purposes, it includes pension funds, it includes administrators, Section 13B administrators, it includes FSPs, Category 1, 2, and 3. And what's interesting about Category 1 FSPs is on the second draft version, at least, it's only those Category 1 FSPs who provide investment administration services to collective investment schemes and hedge funds who are caught, which I think is quite strange that it's not administrators to other financial institutions as well. Insurers and collective investment scheme mancos are other examples who are caught by the definition of specified financial institution. So all of those financial institutions have a responsibility to ensure that they comply with the minimum standards and requirements set out in the joint standard. There is a concept of proportionality, and this was a main focus of the comments on both the first draft, and certainly when we commented on the second draft, it continued to be a concern for us, is that while the standard contemplates this principle of proportionality, and that where the standard is to be implemented by a particular financial institution, that financial institution can implement with reference to its complexity and its size. But the difficulty, I think, that we will experience in trying to, and that financial institutions engaging with the standard will experience, is trying to do that risk analysis. If it's not clear what is required in terms of implementing the minimum standards, when you take a proportional approach, it becomes very difficult to decide whether you've discharged your duty to meet the standards, the minimum requirements of the joint standard or not. And that becomes a very pertinent question because the standard provides that the governing body has overall responsibility for ensuring that the minimum requirements of the standard are met, and that failure to do so will attract liability for the governing body. They can delegate aspects of this responsibility, but in so delegating, they don't absolve themselves of this responsibility. The standard also includes a very broad definition of senior management, being in addition to the governing body, which obviously the directors in a company context or the trustees. Senior management includes all members or employees of a particular financial institution or functionaries of a particular financial institution, depending which institution we're talking about, who are involved in the oversight of the business of that institution or the strategic planning of that institution. So it may be that that is a broader category of persons. I'm just looking at the exact wording, so I can give you the exact wording, but it's all people who participate in making decisions that affect the whole or a substantial part of the business of a financial institution, or have the capacity to significantly affect the financial standing of a financial institution, or who oversee the enforcement of policies and the implementation of strategies that have been approved by the governing body. So essentially what we're looking at here is not the most senior line of management as we would normally understand it, but perhaps the second tier or the implementation line of management of a particular financial institution. And those people in senior management also bear a responsibility together with the governing body for the implementation of the minimum standards or minimum requirements that are set out in the joint standard. So essentially, whether or not a financial institution is meeting these minimum requirements set out in the joint standard or not becomes a risk question for both the governing body and these members of senior management within the financial institution itself. And therefore it becomes quite difficult where we have these minimum requirements or principles set out together with the understanding that they can be applied proportionally, but without clear guidance as to what that proportional implementation means from financial institution to financial institution. And so governing bodies will need to, when they set out their frameworks and their strategies around cybersecurity and cyber resilience, I think will need to be quite clear as to how they've done that proportionality assessment to ensure that they can back up that risk and document that risk appropriately. Then the other point just to make is really around the, and Arabella can ask you just to flip back to the other slide for me. Thank you so much. The other point really to make is just, of course, the standard sets out testing requirements and hygiene requirements that need to be met. So the fundamentals that need to be met from a cybersecurity and cyber resilience perspective. And that goes to the proportionality point as to how you do that. But built into this, of course, is testing and how you do penetration testing, how regularly you do testing. Now, of course, most financial institutions have outsourced a lot of this, let's call it cyber IT services. A lot of financial institutions are making use of the cloud, for example, to store data or data. So when a particular governing body of a financial institution assesses its own risk against compliance with the joint standard, you are looking not only at the actual operation of the financial institution itself, but also at the outsourcing that is in place and the contracts that are in place with the relevant third parties who render services to the financial institution that relate to cybersecurity or cyber resilience. And the obligation imposed by the joint standard effectively on, let's take, for example, a pension fund trustee making up the governing body of that pension fund, is to ensure that the documentation is appropriately crafted or drafted such that there is an obligation placed on the service provider, even if the service provider is not a financial institution itself who is subject to the joint standard. The obligation must be placed on the service provider to do whatever needs to be done in order to ensure that these minimum requirements are met. And so what is going to be necessary is a wholesale review of all of these service level agreements and contracts that are in place to ensure that each financial institution is able to meet the requirements and to ensure that its third parties meet the requirements. And then perhaps the last point to make on this topic before we hand over to Roger is that there is an obligation to do material incident reporting to the extent that there is a cyber incident or an information security compromise within a financial institution. Now, in order for a financial institution to be able to do adequate incident reporting, again, they need to be able to get information from their third-party service providers if the incident has happened at a third-party service provider or if it's happened in respect of the financial institution's data, but which is under the control or management of the third-party service provider. So that also needs to be taken into account in the service level contracting. The current joint standard allows the financial institution itself to decide what is material. And so again, from a risk management perspective, it's important that governing bodies, when they put together their cybersecurity strategy and frameworks, give some thought as to what the parameters are that they'll apply to decide whether something is material or not. Because the only way to defend against any kind of regulatory action or enforcement action or complaint around whether you did or didn't report is to have a policy that backs up why you thought something was material or non-material, and that you followed your policies and procedures appropriately. So I think that's really all I wanted to raise from a cybersecurity and cyber resilience perspective. And just the takeaway, I think, is that a review of contracts is necessary. Both the contracts with a review of contracts with third parties is necessary, as well as a review of the policies within financial institutions to make sure that these requirements can be met. And again, to go to the point that Arabella was making, time is certainly running out, particularly if the joint standard will be published this year, as is expected. Thanks very much, Arabella. And Roger, we'll hand over to you now to take us through the last 2 points.
Thanks, Jess. So I'm going to cover 2 topics. I'm firstly going to just talk a bit about the new requirements for pension funds that are party to derivatives contracts. And then I'm going to make some comments about bank resolution or resolution of designated financial institutions. I'm going to keep things pretty high level. So let's see how we go. So the regulation of derivatives has come a long way, and sort of unlike the 2-pot system, I think what we've got has been something that's had a proper process and is reasonably clear. When you pick up the document, you can kind of see what it is that the regulator is concerned about. The regulatory instrument we're talking about is a conduct standard. The status of the conduct standard is it's not absolutely final. The conduct standard is lying with Parliament. It's being notified by the FSCA as being a conduct standard which intends to be issued. I'll talk a bit about the timing in relation to that a bit later. So the regulation of derivatives contracts is quite a tricky business, and I think there are sort of a range of reasons for that. The one is just the sheer sort of flexibility of the concept of what a derivative is, and the many different functions that a derivative can perform, some of which are legitimate and desirable, and some of which are extremely risky, verging on toxic. And so you have this sort of very elastic sort of concept, or very wide concept of what a derivative is, and a very wide array of purposes, some sort of dark and devious, and some completely appropriate. And what also adds to the complexity is that the regulatory choice, I think quite understandably, is that the derivatives must be regulated as part of the general regulation of the assets that a pension fund holds. And of course, part of the work that derivatives can do is to regulate the exposures which a pension fund has from those assets. So it really does get quite complicated. The set of rules which have now been published are so in my view, they're broadly consistent with sort of international best practice for this form of regulation. And by international best practice, I'm referring to sort of published good practice standards that are published by the International Organization of Pension Supervisors. And they put out a statement that a status supported by research from the OECD as to how it is that pension supervisors should go about regulating derivatives and what pension funds should do in response. It's kind of hard to improve on how this is all explained. So I'm going to read you just the two critical paragraphs from this OECD document. And that's partly because as lawyers, what we now have to do when we interpret statutory instruments is we have to interpret the statutory instrument, but we have to interpret it in order to give effect to its purpose. And part of the purpose here is what is the regulator concerned about in issuing these standards, and when we try and apply and give meaning to the statutory instruments, we need to be mindful of what the regulatory purpose is, and it's beautifully written here by the OECD. I'm going to read it to you. It says that, they open up with describing the wide range of derivatives contracts, and then they talk about the purposes for derivatives. And this is what they say. They say derivatives can be used for various purposes by long-term investors such as pension funds, most notably as a substitute for direct investment in the underlying asset. And then brackets, because of liquidity, market, timing, tax, or other reasons, and for risk control. Derivatives can also be used to change the characteristics of their portfolio investments, such as the duration of their fixed income portfolio. They can also be used for risk control or hedging, duration control, and general portfolio or exposure management. So those are all sort of good purposes consistent with the kinds of things which one would soundly be concerned about in managing a pension fund. And then here comes the however. It says, however, derivatives can also be used for other purposes, including the S word, speculation and leveraging of portfolios, which can come into conflict with the basic objectives of a pension fund. While derivatives and more generally leveraging can have return-enhancing properties on investment portfolios, their use for this purpose can also expose pension funds to major losses in adverse scenarios as the multiplier effect of leveraging on returns reverses. In other words, leverage is lacquer when it's going your way, but it's completely the reverse squared when it's not going your way. And that's the concern that that the regulator has. There's two additional major risks with the use of derivatives are market transparency and counterparty risks, particularly evident in the case of OTC derivatives, where there is no central exchange to collate and disseminate pricing information and to act as intermediary, ensuring adequate posting of capital and collateral. Okay, so that's what the sort of policy environment objectives are, is to try and find a regulatory instrument that moves through all of this stuff and allows pension funds to properly manage their portfolios, to achieve their objectives, but at the same time to protect pensioners and other stakeholders from some of the sort of hazards. Okay, so that's kind of the background. So what have we got? We've got sort of an instrument that thankfully doesn't try and set a whole bunch of hard rules that everyone must comply with. It spells out generally the principles that must be complied with. Unfortunately for trustees, it places a very substantial onus on trustees to formulate, enforce, and monitor proper risk management. And then there are some disclosure elements. I'm going to go through them. I'm not going to give you a chapter and verse on what's there. I'm just going to give you some of the things that I think are interesting and important. So the first thing is there's an outright prohibition on the use of derivatives for speculative purposes. Okay. The word speculation is defined almost verbatim from the paper I was reading to you from. It says, transactions involving unusual and considerable levels of risk intended to take advantage of short-term market movement for commensurate levels of gain. Okay, so one's always got the problem, well, when is normal return-seeking investment speculation? And I think this definition aims to give you a sense of it. Okay, so firstly, derivatives outright prohibition may not be used for speculation. Then, secondly, there's an outright prohibition on the use of derivatives to leverage or gear the assets of the fund. Okay. Now, there's a doctoral thesis here for Arabella to write on exactly what this means. But the important point here is that and this is a change from earlier draft, is that the concept of leverage is defined with reference to the total assets of the fund. Okay. So I think that the regulator recognizes that many derivatives involve a leverage, and that's not necessarily a problem if it doesn't extend to the full set of assets of the fund. Okay. But there is an outright prohibition on leverage as defined. And then secondly, there's a statement as to there's an implicit provision that says you may use derivatives, and the concept here is for efficient portfolio management. And then there are requirements that apply when derivatives are being used for efficient portfolio management. Broadly, efficient portfolio management means hedging, reducing costs, generating additional capital or income. Okay, so those are permitted purposes for derivatives. The really important point, though, is that there's an overarching requirement that where a fund uses derivatives, it must only do so if its exposure under the derivative contract is covered by appropriate reference assets. So you can call this, there's a prohibition on going naked. Okay, if you concluding a derivative involving a reference asset, you may not be naked in relation to the exposure under that reference asset. Okay, and secondly, as an alternative to having the reference asset as cover, you may hold cash, and the requirement is at least equal to the effective derivative exposure. Okay, so you can conclude a derivative, but you must comply with one of those two requirements. Okay, then so those are what I would call the sort of primary overarching requirements for derivative contracts. In the previous draft, there was a general limit that applied to each fund, that fund may not hold more than 25% of its assets in derivatives. That requirement has been scrapped. So there's no bright line volume number. That doesn't mean that you can do that pension funds can do whatever they want, but I think the regulator has recognized that having a 25% bright line is pretty arbitrary, and what's probably more sound is to have the kinds of principle-based risk management approach to regulating derivatives that we're now seeing in the instrument. Okay. The conduct standard puts specific obligations on the boards of trustees in relation to derivatives. must be a risk management policy that appropriately sets out how risks are going to be managed. Derivatives must be implemented in accordance with the investment policy statement of the particular pension fund. There's an obligation on trustees to obtain legal and technical advice if they don't themselves understand the risks. Okay, I think that and there's a particular obligation on pension fund trustees to watch the fees and costs associated with derivatives, including the sort of some of the very, very sophisticated techniques where fees and costs are netted out of the return and aren't shown as an outflow from the particular transaction. So trustees are required to make sure that they see the whole movie from beginning to end without anything cutting out their visibility on where the fees and costs are. Okay. There are a host of other requirements. The one thing I'm not going to go into is exactly how the exposures and the hedging effect of derivatives contracts must interact with the general exposure of Regulation 28. In other words, if you hold bonds and you sort out the return on bonds and you're getting something else in, how do you net that? Okay, so that's the netting of exposures requirements of Regulation 28, and I'm not going to talk about the way in which you calculate your exposure under your contract, whether you do so on a net basis and how you take account of collateral. That's sort of spelled out in the rules and be a bit much detail for now. Importantly, so just a couple of points. Importantly, there's now a hard rule as to who a pension fund may contract with in concluding derivatives contracts. Okay, so pension funds will, when this takes effect, not be permitted to contract with anyone other than a list of financial services providers. Okay, they won't be able to contract with, for example, the employer company or someone who isn't regulated as one of the listed providers. And then there are specific obligations in the standard to make sure that financial service providers are feeding through periodic information and are doing so in a way that assists the pension fund from complying with its obligations. Okay, so that's what I wanted to cover. The one thing I haven't mentioned yet is when all of this is going to take effect. We don't know yet. What the standard says is it'll take effect a year after it's published. It hasn't formally been published yet, and I suspect that the reason is that the financial disclosure and regulatory reporting requirements are not yet final, and these two really need to talk to each other, because quite a lot of the regulatory work that needs to be done is how you report derivative exposures, both in your financial statements and to your regulator. Okay, but I think sort of watch this space. This is something that's going to require quite a lot of detailed work, and because of the outsized leveraging effect that bad derivatives can have on a portfolio, it's a major risk for a retirement fund and a retirement fund trustees of not getting this one right, and not making sure that the compliance, that everything's in order from a policy and compliance point of view. Okay, that's what I wanted to say about derivatives. Quickly want to just touch on bank resolution. It's particularly topical if you read the Financial Times. This is really what we're talking about. We're talking about South African legislation aligning now with the sort of powers that international banking regulators have had, and which you saw exercised in relation to Credit Suisse with its not so voluntary merger with UBS recently. Okay, so where are we with all of that? There is legislation. It's Financial Sector Laws Amendment Act. It's an amendment to the Financial Sector Regulation Act. It's coming into effect on 1 June 2023. From 1 June 2023, the Reserve Bank will have the powers contemplated by the Financial Sector Regulation Act. Okay. Those powers will substitute the bank resolution powers. And so the curatorship powers that the bank that are currently in place. And I wanted to make 2 points about these powers, given the time we've got left. The first point is to say that it's critical to recognize that the resolution powers are not only capable of being exercised in relation to banks. Okay. The resolution powers are now available to the Prudential Authority in relation to certain groups, and the main groups are banks, systemically important financial institutions, and that could include a very substantial insurer, financial conglomerates, and payment service providers. Okay, and why are these rules important? Why are these provisions important? Why are we flagging them for you now? Is that the regulator has very, very wide powers to carve up financial services groups, and pension fund trustees need to be very alive to that possibility in negotiating contracts with service providers. Okay, so if you have a fund administrator who's part of an insurance group or part of a banking group, you need to be aware of the possibility that that the Reserve Bank has these resolution powers. And then the last point is that when this legislation finally comes into effect, there's a phase-in period, and banks are going to be required to engage in very substantial exercise to raise additional capital to essentially make sure they've got reserve capital in the case of going into resolution. And pension funds should be thinking about their appetite for that capital and the terms on which they're prepared to invest. And that's what I've got time for, Jess. I think you've got 1 minute.
Thanks very much, Roger. Thanks for those observations for us to all take away from this masterclass. Thank you, everyone, for joining us today. And just a reminder that you will receive an email from the events team, which will give you access to this recording. If you'd like to share it with your colleagues, you can do so. You can also still register for the further masterclasses coming up in the series. Next week, we have a masterclass on competition, or competition law focused masterclass, looking at sustainability in the competition from a competition perspective, and looking at, from a South African context, what our competition authorities and Competition Act can do to enable development and innovation to drive the sustainability agenda, one of our upcoming topics. And we also have another panel discussion next week on fintech and the role that fintech has to play, both in driving financial inclusion and in ensuring scale is reached for different technologies and sustainable finance initiatives, which allow for meeting the SDGs and meeting commitments under, for example, the Paris Agreement. So that's the fintech session coming up. And as I said, there are several other masterclasses still up until the end of May. So I encourage you, if you are interested, to please have a look and to register for those. And also you can share it if you'd like to do so. So thank you very much to everyone for joining us, and we will see you again soon. Thanks to the presenters, Arabella and Roger as well. Thank you. Bye-bye.